If you want to grow your savings, now might be a good time to lock in high interest rates of 4 to 5% or more. You can find these rates in high yield savings accounts, CDs, money market accounts, T-bills, and other accounts. However, the Federal Reserve says inflation is going down, which means they might lower these interest rates soon. So if you're planning to buy a home or a car, lower interest rates could save you a lot of money. But if you want to earn a high return on your money, now might be a good time to lock in a high interest rate before they drop. One of the most popular and easiest accounts you can get is a high yield savings account. It works like a regular savings account, but pays you a much higher interest rate, allowing your money to grow faster. Regular savings accounts usually pay as little as 0.01%, while high yield savings accounts pay over 4%. To put this in perspective, $10,000 in a regular account earns just $1 a year. But in a high yield savings account, it makes over $400, which is a huge difference. The best part about these accounts is that you can easily transfer or withdraw your money whenever you need to. Plus, your money is usually FDIC insured up to $250,000 or more depending on the bank, which means if the bank fails, your money is protected up to that amount. So if you don't have a high yield savings account yet, consider switching to one. Banks make money from the money you keep in your savings, so they should at least pay you a higher interest rate, and that's only going to happen if you make the switch. My suggestion when looking for a high yield savings account is to 1, find one with a high interest rate, 2, make sure it's FDIC insured to keep your money safe, 3, look for no account fees or minimum balance requirements. That way you don't have to worry about fees or keeping a certain amount in the account. 4, check that the bank or institution has good customer service. And 5, check for sign-up bonuses. Some accounts offer cash or interest bonuses when you open them and meet a few requirements, like SoFi, for example. So don't miss out on that free money. Now, there are some other very important things you should consider. So I made an easy checklist to help you choose the best high yield savings account, and I also shared my top picks. To access it, just click the link in the description or the pinned comment. Now, although high yield savings accounts have great interest rates, they're sometimes lower than some other accounts because you can access your money anytime. So if you want higher rates, you might need to lock your money away for a set time, like with a CD. So what you can do is keep some of your money in a high yield savings account for easy access and good returns, and put the rest of your savings in a different account that earns a higher interest rate, like a CD. A CD, or certificate of deposit, is a type of savings account where you agree to keep your money there for a set period of time, like 3, 6, or 12 months to 4, 5, or even 10 years in exchange for a higher interest rate. CDs usually offer higher interest rates than savings accounts, with some offering over 5%. One of the best things about them is that you get a fixed interest rate for the whole time you have it. So if you get a 1-year CD with a 5% interest rate, that 5% rate is locked in for the entire year, even if rates go down. Now, one downside of CDs is that your money is locked up for the length of the CD term. So if you need to take your money out early, you can, but you might have to pay a fee or lose some of the interest you earned depending on the bank. So it's best to keep your money in the CD until the end to avoid these penalties. Now, my suggestion when choosing a CD is to 1, look for CDs with the highest interest rates. 2, pick a term that fits when you're gonna need your money. Shorter terms give you flexibility, while longer terms usually offer higher rates. 3, check the penalty for early withdrawal so you know the cost if you need to take your money out early. 4, make sure the CD is FDIC insured for safety. And 5, check if the CD will automatically renew at the end of the term and what the new terms will be. Now, if you're worried about rates dropping or can't decide on a term, you can split your money into different CDs with different terms. This way, you'll have regular access to some of your money and can reinvest it at a higher interest rate. Just remember to keep track of when each CD ends. Now, I personally prefer high yield savings accounts because you can access your money whenever you want, and their interest rates are close to CDs, even though they're not fixed. Plus, like I mentioned earlier, some of them offer sign-up bonuses. For example, SoFi gives you $50 to $300 when you receive a direct deposit of $1,000 to $5,000 within 25 days. To put this in perspective, getting a $300 bonus is equivalent to earning 5% interest on $6,000 in a CD. So I'd rather get this account, get the $300 bonus, earn 4.6% interest, and still have access to all my money whenever I need it. If rates drop, I can always look into other options. Remember, you don't have to put all your money in one place. You can keep some in a high-yield savings account and the rest in a CD if you like. Next, we have money market accounts. They're a mix between a savings account and a checking account. You earn interest like a savings account, but you can also use a debit card or checks to access your money like a checking account. Money market accounts are also FDIC insured, so your money is protected up to $250,000 and you can withdraw your money anytime. However, they usually require you to keep a higher minimum balance, anywhere from a few $100s to a few $1,000s to earn interest. There are some with low or no minimum balance requirements, but they usually offer lower interest rates. Overall, money market accounts are a good place to park some cash. But if you're worried about keeping a big minimum balance or having to pay fees if you don't, you might be better off with a high-yield savings account. For example, the SoFi checking and savings account combines savings and checking features. It offers a high interest rate, easy access to your money, and over a $300 bonus right now. So always make sure to check out all your options before making a decision. Another option is money market funds, which you can find at brokerages like Vanguard or Charles Schwab. Money market funds are a type of investment that focuses on low-risk, short-term assets like government bonds or CDs. These accounts are sometimes treated like high-yield savings accounts because they're a good place to grow your money while being able to access it easily. Just like high-yield savings accounts, money market funds don't have a fixed interest rate. Instead, it changes with the market rates. However, they usually pay higher interest rates than high-yield savings accounts. Now, while money market funds are a good place to park some cash and earn good returns, they might not be the best option if you want to lock in an interest rate, because if the Feds lower interest rates, the interest rates on these accounts may drop too. One other thing to keep in mind is that unlike many other savings options, money market funds aren't insured by the government like FDIC insurance. However, if you hold them at a brokerage firm, they might be protected by SIPC insurance up to a certain amount, like $500K. Next, we have T-bills, also known as Treasury bills. Think of T-bills as a way to lend money to the US government for a short time, between 4 weeks to a year. After this period, the government pays you back more than you paid for the T-bills. Here's how it works. You buy a T-bill at a discount, meaning you pay less than its face value. You hold onto it for the specified time, which could be a few months to a year. Once the T-bill matures the end of the term, the government pays you back the full face value. Now, what's great about T-bills is that they're backed by the government, so they're safe. And they usually offer high rates that are locked in for the whole term. For example, if you buy $1,000 in T-bills for $970, at the end of the term, you'll get $1,000 back. So you made $30 in profit. Obviously, the more T-bills you buy, the more money you can make. The most recent 52-week T-bills have an interest rate of 4%, and the ones with shorter terms offer even higher interest rates above 5%. So if you want to lock in a high rate before interest rates drop, T-bills could be a great option. You can buy them directly on the Treasury Direct website or on a brokerage like Fidelity or Vanguard. Now, although T-bills are a good investment, they shouldn't replace your savings account. It's better to keep most of your money in a high-yield savings account or money market account so you can access it easily, and any extra cash in T-bills so your money isn't fully locked up. Another option you can consider is I-bonds. They're long-term investments that last up to 30 years and help protect your money from inflation. I-bonds have an interest rate that's fixed for 6 months. After that, the rate changes based on what's happening in the market. In 2022, I-bonds actually offered a record high 9.62% interest rate for a 6-month period, which was amazing. Now, even though I-bonds are long-term investments, you don't have to hold them for the full 30 years. You have to keep them for at least 1 year, but after that, you can cash them out. However, if you cash them out before 5 years, you'll lose the last 3 months of interest. But after 5 years of holding, there's no penalty. You can also only buy a certain amount of I-bonds each year. You can buy up to $10,000 per year through the government's Treasury Direct website, and you might also be able to buy another $5,000 with your tax refund, making it a total of $15,000 per person each year. Now, although I-bonds offer great rates, the interest rate only stays the same for 6 months and then changes based on the market. This can be annoying if you prefer a more hands-off option where you can lock in a high rate and not worry about it changing. So if you want to really lock in a high rate, a CD or T-bills might be better since their interest rates stay the same for the whole term, so you don't have to worry about market changes. If you prefer a place to keep your cash where you can earn a decent interest rate and still access your money whenever you want, high yield savings accounts, money market accounts, or money market funds are great options. Just remember their interest rates can change at any time. And if you're just looking to put money away for a long time, I-bonds may be a better fit. But there's really no one size fits all answer because the best choice depends on your preferences and goals. You can also mix and match. For example, if you have 20K, you can put 10K in a high yield savings account or money market account for easy access, 5K in a CD for a fixed interest rate, and the other 5K in T-bills or I-bonds. The point is that you have options. You just have to think about your goals and what works best for you and make your decision from there. Personally, I like to invest in real estate and index funds and keep the rest of my cash in high yield savings accounts because I like having full access to my money whenever I need it. But I might start putting some money into short-term CDs or T-bills to lock in some of these current high interest rates. We'll see. Anyway, let me know in the comments which accounts you prefer, where you're keeping your cash, and any other suggestions you have. By the way, in addition to the high yield savings account checklist, I've added links in the description to my favorite high yield savings account with a limited time $325 bonus, some of my favorite credit cards offering great bonuses and cash back, and a shopping portal where you can earn cash back on your purchases and boost your savings. Using those links helps support the channel and lets me keep making these free videos for you guys, so thank you in advance. With that being said, if you like this video, you might also like this other one, so feel free to check it out.